So far, we've examined some sources of risk for various securities. Mostly, we examined risky outcomes for an individual security in isolation. For example, we characterized how the return of a long-term bond might deviate from its yield to maturity over a short investment horizon. But investors do not and should not just hold one security at a time. In this lecture, we'll examine how holding combinations of securities can alter the nature of the risk of each individual security. Once we understand how investors' overall risk depends upon how securities are combined together, then we can see how to combine them purposefully to generate a sensible investment goal. The material in this lecture will also be useful for understanding the subsequent lectures on asset pricing models. Models that determine the amount an investor should get paid for bearing risk contained in an individual security. In this lecture, we'll examine the following topics: the value of diversification, how different combinations of individual securities create different portfolio return characteristics in terms of risk and return, and the extent to which risk can be reduced without also reducing average return, as captured in something called the efficient frontier. We'll also look at the benefits in terms of risk and return associated with diversifying the characteristics given available securities. We'll also look at the type of information on individual securities needed in order to build an optimal portfolio. So let's start by considering an investor who has $100,000 to invest. Initially, we'll just consider a situation in which the investor is trying to decide how much money to allocate across two risky securities. Think of this problem as an investor trying to think about how to decide how much to invest in a domestic versus a foreign security, or how much to invest in stocks versus risky corporate debt. We will characterize each one of these securities in two dimensions: its expected return and its return variance. We will consider another set of characteristics later when we discuss how the characteristics of the return of an individual security affects the characteristics of the return on the portfolio comprised of those individual securities. As defined in earlier sections of the course, recall that the return on a security from T to T plus 1 is defined as the price at T plus 1 plus the dividend flow between T and T plus 1 minus the price at the current period T, all of that divided by the price at the current period T. For the purposes of this lecture, we're going to simply ask you to think about the returns as just random variables. So when I talk about the characteristics of an individual security, I will be referring only to that security's expected return and its return variance. To see things visually, think about a plot of the characteristics of individual securities on a graph. On the horizontal axis, put the standard deviation, and on the vertical axis, put the expected return. For example, let the expected return for Ford be 8.1%, with a standard deviation of 8.2%. Let IBM have an expected return of, say, 5%, but a higher standard deviation at 17.3%. And then finally, let Caterpillar have the highest expected return at 10% and the highest standard deviation at 24%. Two quick asides. First, I should stress here that often the numbers used in the graphs or numerical examples are just for concreteness and may not be current or even realistic. When the magnitude of a variable is important, I will stress that you should take the number seriously. In the case of Ford, IBM, and Caterpillar now, both the levels and the numbers of their rankings in terms of which is higher or lower have been chosen just purely for illustration. Second, I will also slip back and forth between variance and standard deviation. Realize that both give you the same information. Knowing one tells you what the other one is. While I might refer to the variance of the return of a security or a portfolio, the figures you typically see in textbooks and on the web usually show the standard deviation. There are two reasons for this. One, as we discussed before, standard deviation is easier to interpret for returns because it is in percent rather than with variance, which is percent squared. Two, some of the relationships are linear, i.e. are straight lines, when plotted in expected return standard deviation space. Some things, when plotted in expected return variance space, are not linear. So while I might refer to the variance of some security, the information contained in that variance might be depicted or expressed as a standard deviation in a figure or in an equation. Okay, back to the characteristics of individual securities. It is important to always keep in mind that in any given period, the actual return of an individual security may be very different from its expected value. In order to keep this in your mind, I will always use some terminology routinely used in probability and statistics. For a random variable, such as the return on a specific security, we might refer to the expected value and the realized value. The realized value is the value that actually occurs given a single draw from the distribution. The expected value is the probability-weighted sum of all the possible values that might be realized. For example, consider the flip of a fair coin. Let's say that you get $1 if it comes up heads, and you have to pay $1 if it comes up tails. The expected value is 0.5 times 1 plus 0.5 times -1, which equals 0. If a coin is flipped and it comes up heads, we would say that 1 was the realized value. If it comes up tails, then the realized value is -1. In this case, the expected value is 0, and it's also not one of the two possible values on any one flip. For securities, even though the expected return for Ford is lower than the expected return for Caterpillar, the return actually realized for Ford in one period may be actually higher than that realized for Cat. In the next section of the lecture, we'll examine what is referred to as portfolio theory. Portfolio theory considers how the return characteristics of an individual security affect the characteristics of the return on a portfolio of individual securities. In portfolio theory, a portfolio is defined as a set of weights. W equals W1, W2, W3, all the way up to a generic entry, W sub little n, all the way up to the final entry, W sub cap n. Here, cap n is the total number of securities being considered. The little n is the generic index for a generic security, ranging somewhere between 1 and cap n. W sub little n is the weight placed on this generic security. At this point, don't worry about how we got to know about these N securities. Later we will discuss which N securities might be good to know about and whether it makes any sense for you to spend time and or money getting to know about additional securities. To create intuition, let's first consider a simple portfolio consisting of only 2 securities. We'll examine how the characteristics of the portfolio returns change as we systematically vary the weights from all on one and none on the other to none on the first to all on the other. For example, consider the following simple portfolio. Out of $100,000 to invest $30,000 in Ford and $70,000 in IBM. In this case, the portfolio weights will be 30% or $30,000 out of $100,000 in Ford and 70% in IBM, or $70,000 divided by $100,000. With this portfolio, the expected return on the portfolio is the weighted average of the expected returns on the individual securities, where the weights used in the average are the portfolio weights for each individual. So the expected return for the portfolio is going to be equal to 0.3 times the expected return for Ford, plus 0.7 times the expected return for IBM. In this case, we have 0.3 times 8.1% plus 0.7 times 5%. That equals 7.16%. That's the expected return on the portfolio of 30% in Ford and 70% in IBM. In general, we can write the expected return as the following formula. The expected return on the portfolio, let's call it R sub port, is equal to weight 1 times the expected return on the security 1 plus 1 minus weight 1 times the expected return on security 2. With this expression, we can systematically vary the weights between the two securities and see how the expected return and the standard deviation vary. Let's first examine what happens to the expected return. To see the relationship, let's start off with all our weight on Ford and examine what happens to the expected return on the portfolio if we take some of the weight away from Ford and give it to IBM. Such an exercise is equivalent to starting off with investing all of your $100,000 in Ford and then taking money away from Ford, say $1,000 at a time, to invest in IBM. If we start with a portfolio that has the whole $100,000 invested in Ford, then the weight on Ford is going to be 1, and the weight on IBM is going to be 1 minus the weight on Ford. It's going to be 0. So the expected return on that portfolio is trivially just the expected return on Ford. If we take away $1,000 from Ford, we're reducing the weight on Ford by what? 1,000 divided by 100,000, or 1%, 0.01. And we're increasing the weight on IBM by 0.01. Since the expected return on IBM is lower than Ford's expected return, the expected return on the portfolio gets pulled down by moving money to IBM. Every time an extra 1% weight is taken away from the higher expected return on Ford and reallocated to the lower expected return on IBM, the expected return on the portfolio falls. It falls by 0.01 times the difference between the expected returns on Ford and IBM. In this example, the difference is 3.1%. Thus, if we take 50% of the weight away from the initial 100% allocation to Ford, the expected return on the portfolio will be the expected return on Ford minus 0.5 times 3.1%, for a total portfolio expected return of 8.1% minus 0.5 times 3.1%, or 6.55%. If we take all of the initial weight away from Ford and give it to IBM, then the expected return on the new portfolio is simply 5%, the IBM expected return. Now let's see what happens to the variance, or the standard deviation, as we take weight away from one and give it to another. As discussed previously, the variance of the portfolio return is more complicated than that of an individual security because we need to know how the return on one security is related to the return on the other. For example, consider the case in which one security has a big positive return and the other security typically has a big negative return. And when the first has a big negative return, the other has a big positive. Let's say that these securities very infrequently have small or medium negative or positive returns. Thus, both of these securities are high variances when considered alone. Now consider a portfolio with a 50-50 split between the two securities. In this case, the expected return on the portfolio return will clearly be close to 0. What about the variance in this case? When the first security has a positive return, then the typically negative return of the other security will pull down the portfolio return, and it'll pull it down to 0. Similarly, when the first security has a big negative return, then the typically positive return of the other pulls the portfolio return up to 0. In this case, the variance of the portfolio return is low since regardless of what happens to either individual security, the portfolio return is close to the mean return of 0. This implies that the portfolio return has a small variance. Thus, even though both of the individual securities have high variance on their own, the portfolio variance is small. In contrast, consider a case in which when one security has a big positive return, so does the other. And when the first security has a big negative return, the other one does as well. Taken alone, they both have only large positive and large negative returns. And as a result, they both have large individual variances. In this case, the return on a 50-50 portfolio will either be big positive when both are big positive, or big negative when both are big negative. Since we don't know a priori which will occur, the average return on the portfolio will be close to 0, the average of the big positive and the big negative. But the variance will be large because the realized returns on the portfolio will either be big positive or big negative. Note that in both cases, the individual securities had large variance. But in the first case, the variance of the portfolio return was small, whereas in the second case, the variance of the portfolio variance was large. This relationship can be captured by using the concepts and formulas for correlation covariance discussed in an earlier lecture. Recall that the covariance of two random variables is the expected value of the product of one variable's deviation from its mean and the other variable's deviation from its mean. If the most likely outcomes are associated with one being above its mean while the other is also above its mean, then the covariance is positive. If the most likely outcomes are associated with one being above its mean while the other is below its mean, then the covariance is negative. The correlation ranges from 1 to -1, with the sign indicating whether the covariance is positive or negative, and the magnitude of the correlation indicating the strength of the relationship. If the correlation is 1 or -1, then they are perfectly positively or negatively correlated. And knowing one tells you exactly what the other is. A correlation of 0 says that there is no connection between the two at all. Given the variances of the two returns and the covariance between these two returns, there is an expression for the variance of a linear combination of these random variables. We can use this expression for portfolios because the return on a portfolio is just a weighted average of the returns on the individual securities. For a two-security case, the variance of the return on the portfolio consists of three main parts. The first is the weight on the first security squared multiplied by the variance of the return on that security. The second is a similar expression, but for the second security. It is the weight on the second security squared multiplied by the variance of that security. The third component utilizes the correlation between the two securities. It is 2 times the weight on the first security times the weight on the second security, all of that multiplied by the covariance. The covariance is equal to the correlation between 1 and 2 times the standard deviation of 1 times the standard deviation of 2. Let's consider 3 special cases. 1, when the correlation is positive. 2, when there is no correlation. And 3, when the correlation is negative. Of these 3 cases, positive correlation is the most likely for securities. This is true since most securities move in the same direction. When there's good news in the market, say the economy is recovering from a recession, then that is typically good news for most securities, which are also likely to have very positive returns on that day. Similarly, most securities will have negative returns on a bad news day. Next, consider this positive correlation. Let's consider this positive correlation case next. To get some intuition for this case, let's consider the extreme case in which the positive correlation is very, very strong, with a correlation equal to 1. When the correlation is 1, then a bit of algebra shows that the standard deviation of the portfolio return reduces to the following expression. Standard deviation of the return on the portfolio is the weight on the first one, not squared, but just the weight on the first one, times the standard deviation of the first one, plus the weight on the second one, times the standard deviation of the second one. That is just like the expected return. The standard deviation of the portfolio is just the weighted average of the standard deviations of each. It is useful to see combinations of expected return and standard deviation that you can create for yourself with a portfolio with just 2 securities. For this, consider a plot of return characteristics that we discussed earlier. On this plot are 2 points for each security. Let's say security A has a low standard deviation, but also a low expected return. Security B has a high expected return, but also a high standard deviation. If we start with all the weight on A, the portfolio return will have a low standard deviation and a low expected return. As we take weight away from A and reallocate it to B, both the expected return and the standard deviation will rise. In fact, as we take weight from A and move it to B, we plot out a straight line from the point that represents A to the point that represents B. Let's next examine combinations we can create for ourselves if there is perfect negative correlation. This is rare for securities that represent the claims on actual cash flows from firms, like stocks and bonds. This is true because it requires that when one firm is doing well, the other firm is doing really poorly. This requires something of a zero-sum game, where a zero-sum game is one in which when one person wins, the other one loses. When you have firms that compete in the same products in the same markets, then there is some sense in which that's a zero-sum game, when one takes some market share from the other. But that does not necessarily result in perfect negative correlation, because both are going to benefit when the market expands, and both will also suffer when that market contracts. However, we will see that there are derivative securities that are designed to be negatively correlated with other securities. What we'll show next shows why you might want to have such derivative securities. In the case of perfect negative correlation, the standard deviation of the portfolio becomes the weight on the first one times the standard deviation of the first one minus the weight on the second one times the standard deviation of the second one. That is, the standard deviation has the same two parts as in the perfect positive correlation case. Part 1 is the weight on the first security times the standard deviation on the return on that security. Part 2 is the weight on the second security times the standard deviation of that second security. With positive correlation, the two parts are added together. In contrast, with negative correlation, the second part is subtracted from the first. If the perfect negative correlation case exists, since we have the two parts subtracted from one another, this means that we can actually create some really good combinations of expected return and standard deviation by picking the weights to place on each security. In fact, we can actually create a combination that has no standard deviation at all. To form such a portfolio, the weights are, the weight on the first one is going to be the standard deviation of the second security divided by the sum of the standard deviation of the first plus the standard deviation of the second. And the weight on the second is just going to be 1 minus the weight on the first. Okay, so why these weights? Consider what happens when the standard deviations are the same. In that case, a 50-50 portfolio has a return with no variance. When one is down 1 standard deviation, the other is up 1 standard deviation, which exactly cancels each other out. If the standard deviation of one is bigger than the other, then put more weight on the one with the smaller standard deviation. When that one goes down 1 standard deviation, the other will go up by more. But because you have less weight on the one with the bigger standard deviation, it exactly cancels. Consider the plot we discussed earlier. For two perfectly correlated securities, consider the return characteristics of portfolios you can form by moving weight from one to the other. The line is shaped like a V that's on its side, with the point of the V touching the vertical axis. This is the point where the standard deviation is 0. That is, this is the portfolio that has no variance. So far, we've been looking at combinations of securities in which we have perfect positive or perfect negative correlation. We've been putting those into portfolios to look at what the expected return is and the standard deviation of that. What happens if we have imperfect correlation? All right, the result is essentially in between the perfect negative and perfect positive cases. To see what happens exactly, let's consider a case in which there's no correlation. In that case, the standard deviation of the portfolio return is going to be equal to the following. It's going to be the square root of the weight on the first security squared times the variance of that security, plus the weight on the second security squared times the variance of that security. In this case, there will be a reduction in standard deviation that is indeed possible. To see this, consider a simple example of two variables that have the same variance and are uncorrelated with each other. The two random variables are two independent flips of a coin. Let heads pay $1 and tails pay negative $1. Now let's form a portfolio that is half of the payoff from one flip and half of the payoff from another flip. Which would you prefer? The payoff of one flip, or would you prefer this portfolio? In the one flip case, you can only get $1 or negative $1 for a standard deviation of 1. What about in the two flip case? Well, there are three distinct outcomes in terms of payoffs. You could get 1. That only happens when both flips are heads. Thus, that only happens, 25% of the time. 0.5 times 0.5, 25% of the time. Also, you could lose $1. That only happens when both flips are tails. And that, again, only happens 25% of the time. These two outcomes are the same as those associated with the one flip of the coin. But with the flip of just one coin, 1 and negative 1 are the only two possibilities covering 100% of the probability. With half the two flips, we only have covered 50% of the total probability with 1 and negative 1. The other cases, with the other 50% of the probability, are better. One outcome is first is heads and the second is tails. This occurs 25% of the time. The other outcome is first is tails and the second is heads. This also occurs 25% of the time. In these cases, which happens a total of 50% of the time, the payoff is 0, which equals the mean. Thus, the standard deviation of the portfolio of independent flips is lower than the standard deviation of any one flip. What this implies with respect to the plots we've discussed before is that you can get a reduction in the standard deviation of the portfolio return relative to the standard deviations of each individual security. Rather than an on its side V for the perfect negative correlation case, what you get is an on its side U, where the bottom of the U corresponds to less standard deviation than either of the two individual securities. Okay, so far we've considered just combining two securities together into a portfolio. If you combine many securities together, then you can get an even bigger variance benefit. In fact, for any given level of expected return, a portfolio of a complete set of securities can be formed to produce the lowest possible standard deviation. To get the minimum variance portfolio for a particular mean return, simply search over all the different sets of weights. Remember W1, W2, all the way up to WK, until you find the weights that are associated with the lowest possible variance. Now, there exist formulas for the minimum variance portfolio weights for any given expected return, but it's very complicated and it's best calculated using something like a spreadsheet or a statistical package like Mathematica. There are some portfolio optimization tools that you can find online that will do this as well. The set of combinations of the expected return and the lowest possible standard deviation is referred to as the minimum variance frontier. This frontier is actually a hyperbola. It's like this U that's sitting on its side. The portfolio that is associated with the lowest standard deviation is called the global minimum variance portfolio. This is the portfolio associated with the bottom of the on its side U, the point that is closest to the vertical axis. Note that there are some points on the minimum variance frontier that are not particularly useful. For example, why would anyone want a portfolio on the lower part of the hyperbola, on the lower part of the U? On the lower part of the hyperbola, the expected return is lower than that associated with the global minimum variance portfolio. For any possible level of portfolio risk, you can get a higher expected return by picking the portfolio on the upper branch associated with that level of standard deviation, rather than the portfolio on the lower branch associated with that standard deviation. The efficient frontier is the minimum variance frontier with all of those useless portfolios thrown out. Note that you may be able to shift the frontier towards the y-axis, that is, towards less variance, by adding additional securities. This is especially true if you add securities that are either uncorrelated or are negatively correlated with the current set of securities that you have. Such a shift typically occurs when you add the securities of foreign markets, actually. This is good in that any given expected return, you will have less risk in the portfolio. Clearly, portfolios on the efficient frontier are better than any inside the frontier because the efficient frontier gives you what? The highest expected return for the lowest variance. But of the portfolios on the frontier, which is the one that you actually want? So there's many on the frontier. Which one do you want? Before we get to that, let's put this risky portfolio into a larger context. Specifically, note that the efficient frontier only contains risky securities. These are either stocks or bonds that mature at different times, different horizons than your holding period. The portfolio you want will contain both risky and risk-free securities. The risk-free securities will be investments like in treasury bills or money market accounts, say. What kind of trade-offs between risk and expected return can you create for yourself when you include risk-free investments? Basically, you will want to hold a fraction of your wealth in the risk-free investments and only one of the portfolios on the frontier. In an expected return standard deviation plot, consider a portfolio on the frontier. Because the risk-free return is not random, then any combination of wealth invested in the risk-free and that portfolio will create the set of expected return standard deviation combinations along a line from that risk-free rate at zero risk through the point representing that risky portfolio. If you want to bear little risk, then you want to invest less in the risky portfolio and more in the risk-free security. As you increase the amount of your wealth that you put at risk, you slide up that line. The slope of this line is called the Sharpe ratio for that risky security, for that risky portfolio. In general, the Sharpe ratio for any portfolio is defined as S sub P. It's equal to the expected return on that portfolio minus the risk-free rate, all of that divided by the standard deviation of the return on that portfolio. Intuitively, this measure tells you how much extra expected return you get per standard of deviation for that given portfolio. For example, consider a risky portfolio with an expected return of 10%, which exceeds the risk-free rate of 3% by 7%. Let the standard deviation be 20%. Then the Sharpe ratio for this portfolio is going to be 0.07 divided by 0.2. It's going to be equal to 0.35. Thus, with this portfolio, you will get a 35% return per each percentage point of standard deviation. So which of the portfolios on the efficient frontier do you want? You want the portfolio that generates the highest Sharpe ratio. You then control the amount of risk you want by deciding how much of your wealth to actually put at risk. But for each unit of risk, you'll be getting more return above the risk-free rate than any other portfolio per unit of risk. In the next lecture, we'll examine a parsimonious way to get the parameters required to form an efficient portfolio. The set of techniques will also be useful for getting indications of mispricing that might suggest opportunities for excess returns. Before we get to such opportunities, however, we will explore an asset pricing model that will provide some useful benchmarks in terms of what is considered excess. But we're going to be using the tools that we've developed in this lecture in those subsequent lectures.